Silver just got destroyed, from $91 down to $85, $6 gone, wiped out in a single session. And if you're watching this right now with your portfolio bleeding red, if you're feeling that pit in your stomach, if you're thinking about selling everything and walking away from silver forever, I need you to stop. Stop right there. Because what I'm about to show you over the next 20 minutes is going to completely flip your understanding of what just happened. By the time this video ends, you're going to know exactly who crashed silver, why they did it, and why I believe this crash is not the end of the rally, it's the setup for something much bigger. I was up until 3 a.m. last night going through data, vault reports, delivery notices, exchange filings, and what I found made me furious. Not because silver crashed, I've seen crashes before, but because this crash follows a pattern so obvious, so predictable, that once I show it to you, you'll never look at these end-of-month moves the same way again. Let me tell you what happened. The CME, the Chicago Mercantile Exchange, the place where silver futures trade, they halted trading yesterday. Not just silver, everything, gold, copper, platinum, natural gas, the entire metals complex, shut down mid-session, no warning. And the explanation they gave? Technical issues? Technical issues. I don't buy it. And by the time I'm done walking you through what I found, I don't think you will either. Before I get into the data, if you're new here, welcome to Finance Currency. This is the channel where we cover silver, gold, and the hidden moves in the financial system. No fluff, no hype, just raw data and real analysis. If that's what you need right now, hit subscribe, hit that like button, and hit the notification bell because the information I'm about to share could change how you invest for the rest of this cycle. Also, I want to try something new today. I want to know who's watching this video. What time is it where you are right now? What city are you watching from? And drop your name in the comments. I want to see who my beautiful audience is. I want to know the names of the people who are here learning with me. So pause for a second, drop a comment, tell me your name, your location, and what time you're watching this. Let me see my Finance Currency family. Now let's get into it. Let me show you the pattern, because once you see this, you cannot unsee it. December 2024, last 2 days of the month, silver was trading at $83. Strong, stable, building momentum. And then out of nowhere, it crashes, 83 to 70, $13 gone in 48 hours. No news, no fundamental change, no supply disruption. Just a violent sudden move down right before the month closed. People panicked, people sold. I got messages from viewers saying they were done, they couldn't take it anymore. And then what happened? January started, and silver recovered everything, not slowly, fast. Within weeks, silver was back at the highs and pushing higher. January 2025. Same story. I watched silver run all month. Building, climbing, it hit $121, the all-time high. People were celebrating. The momentum was unstoppable. And then in the final 48 hours of January, silver crashed from $121 to $70, $51, a 42% drop in days. I'll never forget the messages I got. People asking if they should sell at massive losses. People saying silver was finished. People angry at me for telling them to hold. And then what happened? February started. And silver ripped right back up, 70 to 91, in 5 weeks. Now February, last day of the month. And what's happening right now? Silver crashed $6, almost 7% from the high. 3 months in a row, December, January, February. Right at the end of the month, silver gets slammed. And every single time the following weeks it recovers and pushes higher. Once is random, twice is suspicious. 3 times at the exact same point in the cycle, that's a pattern. And when I see a pattern this clean, I stop looking at price. I start looking at who benefits. Because somebody wins when silver drops $6 in a single session. Short sellers win. The people who need to deliver silver at expiration win because the metal they owe is suddenly cheaper. And the exchange itself wins because a lower price reduces the incentive for buyers to demand real physical metal. When you map out the winners, the motivation for these crashes becomes obvious. But here's what really got me, the timing. The CME halt happened at the most sensitive moment of the entire month. We are at the end of February. March 1st notice day is tomorrow. March is a major delivery month on the futures calendar. The open interest in silver has been abnormally high. Way more contracts than normal that haven't been rolled or matched. And in that exact moment, with all of that pressure building, they decide to shut everything down. I went back and looked at historical exchange halts. Metals halts at the CME during expiration week are extremely rare. This isn't normal. And the fact that they halted everything, not just silver, tells me the problem was systemic. The entire system was under pressure. I can't tell you with certainty what happened behind closed doors. Nobody can. But I've studied how these markets work. I've read accounts from traders who have sat on trading desks during these situations. And what happens when there are more buyers than sellers at expiration is not pretty. Stay with me, because in the next section, I'm going to walk you through exactly how this manipulation works, step by step. And once you understand the mechanics, everything about these crashes makes perfect sense. Now, I need you to really focus here, because this is where everything clicks. At the end of every month, futures contracts expire. When a contract expires, the person holding it has a decision to make. Either roll it forward to the next month, which means you're essentially pushing your bet into the future, or stand for delivery. That means you're saying, I don't want paper. Give me the physical silver. I want the real metal. Here's the problem that hit me hard when I dug into the numbers. Over the last 3 months, more and more people are demanding real metal. Not paper promises, not contracts, physical silver. In February alone, 24.8 million ounces were moved through the COMEX vaults, real metal leaving the vaults. And registered silver, the silver that's actually available for delivery, has dropped from over 150 million ounces to 87 million. The vaults are getting lighter every single month. Now picture this, end of the month. More people want delivery than there are sellers willing to deliver. What do you have? You don't have a price crisis. You have a logistics crisis, a matching crisis. For every buyer who wants physical silver, you need a seller who has physical silver to give them. And when the numbers don't add up, someone has to step in. This is where yesterday gets very interesting. The CME halted trading across all metals. They said technical issues, but think about the timing. We are at the end of February. March 1st notice day is tomorrow. March is a major month on the futures calendar. The open interest has been abnormally high, and in that exact moment, they shut everything down. Let me walk you through how I believe this actually works. Because once you understand the mechanics, everything about these crashes clicks instantly. The exchange picks up the phone. They start calling participants. They ask sellers to step up. They tell buyers to wait. They promise them their metal next month. They work through the list one by one. The impatient buyers get talked into rolling their contracts forward. The patient ones get promises of delivery in 30 days. Once enough buyers agree to wait, trading resumes. But think about what just happened. All that buying pressure I was watching build all week? Gone. The only people left in the market are sellers. And sellers push price down hard. I know some people will say I'm reaching, that this is conspiracy talk. It's not. These are market mechanics. This is how futures markets have always worked when buyer demand exceeds available supply. The exchange's job is to maintain an orderly market. And when the market can't match buyers with sellers, shutting down is the orderly response. But the result for you watching the chart is a crash that looks organic when it's actually manufactured. Let me show you something that proves this wasn't a normal sell-off. I watched what silver did yesterday in real time. Before the halt, silver was already dropping. The halt happened. And after the halt, silver continued selling off. But gold was up $20 on the same day. Think about that for a second. Gold up 20, silver down over 2. On any normal day, gold and silver move together. I've checked the correlation for months. It's above 0.8. They almost always move in tandem. So when I see gold rally $20 while silver gets hammered for $2 on the same afternoon, I know something else is going on. Same market, same macro environment, same exchange. If this was a real move driven by fundamentals, both metals would go in the same direction. The fact that gold rallied while silver got destroyed tells me this was targeted pressure on silver during the most sensitive time of the month. When I put this together, it clicked instantly. Silver is the metal with the delivery problem. Silver is the metal where registered inventory dropped from 102 million to 87 million in 2 weeks. Silver is the metal where Wells Fargo just delivered 228 contracts in one session. Gold doesn't have the same delivery pressure right now. So of course silver is the one that gets knocked down, because silver is the one where the matching problem exists. And here's what really made me sit up straight when I was going through the data. This exact same thing happened on Black Friday. The market got halted. Silver dropped. And the explanation was the same. Technical issues. 2 halts in recent months. Both at critical expiration periods. Both followed by silver dropping hard. Both with gold moving in the opposite direction. I'm not saying the market is rigged in the way that some people throw that word around. What I'm saying is that the structure of the futures market creates these situations by design. When you have a system where paper promises outnumber physical metal by a massive ratio, and delivery time comes, the math doesn't work. And when the math doesn't work, the exchange has to intervene to keep things orderly. That intervention is what we see as a crash. It's not a natural sell-off, it's an engineered cool-down to prevent something much worse. A default, a moment where someone says, give me my silver, and the vault says, we don't have it. That hasn't happened yet, but the pressure is building every single month. And these end-of-month crashes are the relief valve. The people running these markets don't care about the price going up. Gold is at 5,100, silver touched 91, they've accepted that. What they cannot tolerate is the speed of the price rise, a steady grind from 80 to 90 over 3 months. They can manage that. But silver going $6 in a few sessions, the delivery math breaks. More people stand for delivery than the system can handle. These crashes are about velocity, not direction. Once I understood that, everything made sense. They let it run, then they cool it off. Then they let it run again, managing the speed, not the destination. Now let me show you something that changes this entire picture. I found a JPMorgan report that almost nobody is talking about. It got buried inside a mining research note, and when I read it, I had to read it twice to make sure I understood what they were saying. JPMorgan ran scenario analysis on where gold reaches equilibrium under different monetary outcomes. The range they came up with is $5,900 to $9,300 per ounce. I need you to hear that number again. JPMorgan, the bank that literally makes markets in gold and silver futures, the bank that holds massive positions in precious metals. They put out a scenario where gold reaches $9,300. Not some guy on Twitter, not a YouTube channel, JPMorgan. And if they're modeling gold at 9,300 even as a scenario, that tells you where they think the monetary system is heading. And if gold's floor, according to their analysis, is around $4,500, what does that mean for silver? Using the historical gold to silver ratio, if gold's floor is $4,500, silver's floor is somewhere between $50 and $75. JPMorgan themselves are suggesting silver doesn't go below 70. Now I want you to connect the dots. Silver went from 91 to 85. That's still $15 above the floor that JPMorgan is quietly establishing. This crash brought us nowhere near the floor, not even close. This is not a reason to sell. This is a reason to pay close attention. Because JPMorgan doesn't just analyze this market. They make markets in it. They hold massive positions. And now they're publishing research telling clients the floor is in. When the market maker starts telling you where the floor is, it's not just analysis, it's positioning. Let me stack more evidence for you. I pulled up the vault numbers this morning. COMEX registered silver is at 87 million ounces. 2 weeks ago, it was over 102 million. 15 million ounces gone in 14 days. And this crash didn't add a single ounce back to the vaults. Not one. Shanghai is still trading silver above $100. The premium over international spot is still massive. Chinese buyers are still paying more than anyone else on the planet for physical silver. That demand didn't disappear because the CME halted trading for a few hours. Here's another one that should make you think. Wells Fargo just delivered 228 out of 229 contracts in a single day. BNP Paribas, HSBC, JP Morgan, Goldman Sachs, all on the receiving end, all taking delivery of physical silver. You think those banks stopped wanting silver because the price dropped $6? They didn't stop. They're still accumulating. Think about what just happened. The price dropped, but nothing in the real world changed. Not a single vault report moved, not a single delivery number changed. The only thing that changed was the number on the screen. I want to share something personal because I think it puts this crash in the right context. In January, when silver crashed from 121 to 70, I thought about every message I'd gotten. People who bought at 110 asking if they should sell, scared, angry, not knowing what to do. I told every single one of them the same thing. Hold. Don't sell at the bottom of a pattern that has repeated before. And I was terrified I was wrong. I'm not going to lie about that. When silver hit 70 and people were sending me screenshots of their losses, I questioned myself. I went back through every number, every vault report, every delivery notice, and the data hadn't changed. The only thing that changed was the price on a screen, so I stuck with my call. Every single one of those people who held through that crash watched silver go from 70 back to 91 in 5 weeks. Same thing I'm telling you right now. Zoom out. The drop was in the price, not in the supply picture. Rick Rule is already making his move. If you don't know who Rick Rule is, look him up. He's one of the most respected names in resource investing. He's been selling physical metal and loading up on mining stocks. When a guy like Rick Rule starts rotating, I pay attention. He's not abandoning the bull market. He's positioning for the next phase because he thinks miners are about to go vertical. If miners are about to go vertical, it means the biggest players in this market think gold and silver are heading much higher because miners don't go vertical when metals are crashing. They go vertical when metals are breaking out to new highs. And here's the thing about the JPMorgan report that nobody is discussing. They didn't release this by accident. When a bank like jpmorgan publishes research with numbers like $9,300 gold, they're sending a message to their institutional clients. They're saying, we see what's coming, position accordingly. The retail investor sees the crash and panics. The institutional investor sees the jpmorgan report and buys the dip. Which side do you want to be on? By the way, I'm still waiting to see those comments. What time is it where you are? What country are you watching from? Drop your name in the comments. I want to see the names of my beautiful finance currency audience. Let me know who's here with me right now, learning this together. The data is clear, the pattern is clear, the positioning is clear. The only question is whether you see it. Let me put this 3-month pattern in perspective, because I think this is the most important framework for understanding silver right now. December crash, 83 to 70. Silver was back near the highs by February. January crash, 121 to 70. Silver recovered in 5 weeks. February crash, down $6 so far. If the pattern holds, and I see zero reason for it to break, silver recovers and pushes higher into March. But here's what catches my eye. Each crash is getting smaller. December was $13. January was $51 from the all-time high, but it started from a much more extreme level after a parabolic run. February, so far, only $6. Selling pressure is weakening. The dips are getting shallower. Buyers are stepping in at 85 instead of waiting for 70. I think the answer is simple. After December, people who sold the bottom at 70 and watched silver rip back up learned their lesson. After January, even more people learned it the hard way. The people still holding silver right now have been through 2 brutal shakeouts. They've seen the playbook. They know how this ends. And they're not selling this time. That's why the crash is only $6 instead of 13 or 51. The weak hands are gone. Look at the lows. December bottomed at 70. January bottomed at 70. February so far has bottomed around 85. The floor is lifting. In December, you could buy silver at 70 if you were brave enough. In January, 70 again. But in February, the lowest price was $15 higher. The discounts are vanishing. The people selling into these crashes are running out of ammunition. There's a level where the physical market won't let silver drop. Because at that price, every industrial buyer, every bank, every refiner steps in and buys everything available. That level was 70 in December and January. Now it's $15 higher. By March, my target is that the floor lifts to 90. When the floor keeps lifting while supply keeps getting tighter, you're looking at a market coiling for a much bigger move. Now let me address the bear case, because I always give you both sides. I respect the bears, and their argument isn't stupid. The bear case goes like this. Silver hit 91 and got rejected. The CME halt spooked the market. There could be margin hikes coming. If March is lighter than expected, some of the urgency fades, all valid points. But the bears can't answer one question. If the rally is over, why are the COMEX vaults still losing 15 million ounces every 2 weeks? The bears have a price argument. But do they have a data argument? They don't. And in a physical commodity market, data wins every single time. If there isn't enough silver, the price goes up. Period. Now let me give you the risks, because I always give you the risks. Risk number 1, margin hikes. When silver moves fast, the CME can raise margin requirements and force traders using leverage to sell. We saw this in January. It causes real damage in the short term. If it happens again, silver could drop another 5 to 10% from here. But every margin hike in this cycle has been followed by a recovery, because you can raise margins all you want. You can't create silver that doesn't exist. Risk number 2. March disappoints. If fewer people demand metal than I expect, the urgency fades temporarily. That would hurt the short-term thesis. But even a quiet March doesn't fix the underlying deficit. The world uses more silver than it mines. That gap doesn't close because 1 month is slower. Risk number 3, the pattern breaks. Maybe February's crash goes deeper than December and January. Maybe 85 doesn't hold. If that happens, I'll tell you. I don't hide from bad data. But right now, sitting here tonight, going through everything I can find, everything says this is a buying opportunity, not a reason to run. Here's exactly what I'm watching for March. Support is right where we are. If this level holds and silver starts bouncing, the dump is done, the pressure is off, and the next leg up begins. If support breaks and silver drops to 80 or below, then I need to reassess whether this correction is deeper than the pattern suggests. I'll be transparent about it. I'll show you either way. But I'm not focused on support. I'm focused on 92. The last major resistance before $100. Silver has been building toward this level for weeks. Every rally gets closer. Every pullback holds higher. And I believe that when silver eventually breaks 92 and closes above it with conviction, the path to 100 is wide open. Why does 100 matter beyond being a round number? Because at $100, silver becomes mainstream news. CNN picks it up, Bloomberg runs it as a lead story, your coworker mentions it at lunch. Retail investors who have never looked at silver suddenly want in. That wave of new demand crashes into a market that already can't meet existing demand. And if you think that sounds extreme, I've watched this play out with other commodities. Once mainstream coverage locks onto a shortage story, buying pressure doesn't come gradually. It comes all at once. With 87 million ounces of registered silver and falling, there's no cushion. The system absorbs the new demand by pushing price higher, much higher. Zoom out with me. Because this is where it gets dangerous for the short sellers. Every piece of the puzzle is lining up at the same time. Pattern says recovery. Vaults say drain. jpmorgan says the floor is in. And March 1st, notice day, is tomorrow. If we see demand anything close to February, when 24.8 million ounces walked out, I think registered silver could drop below 70 million by mid-March. We haven't seen that level in this cycle. And the people demanding metal in March are the ones who just watched this crash and bought through it, not weak hands. People who've seen the playbook 3 months running and are using it against the system. Pull up a chart of silver right now. Look at the space between 92 and 100. There is nothing there. Open air. No major resistance. No historical ceiling. And $100 silver is not the end of the move. It's when the whole world starts paying attention. After 100, everything changes. And I mean everything. The media picks it up. Retail piles in. ETFs have to buy physical metal to back new shares. Mining stocks go parabolic. And the supply that was already insufficient becomes nowhere near enough. I believe we're heading toward that sequence, not tomorrow, not this week, but over the coming months as every new number confirms what we already know. The people crashing silver at the end of every month are not doing it because silver is weak. They're doing it because silver is too strong. They don't care that silver is at 85 or 91. They've accepted the price going higher. What they can't accept is how fast it gets there. If silver was naturally going to fall, they wouldn't need to intervene every 30 days. They do it because without intervention, the price would be at 100 already. Here's my call. I expect silver to get back above 90 within the first 2 weeks of March. I expect it to reach and test 92 again. And when it breaks through with conviction, the run to 100 will be fast. So where do I land after looking at everything tonight? Silver crashed from 91 to 85. The CME halted trading during the most sensitive period of the month. Gold went up while silver went down. 3 months in a row, same pattern. And every time, silver pushed higher afterward. I've been refreshing the vault data every hour, checking Shanghai, watching every notice that posts, and nothing has changed. Not one number. The direction is still up. If you've been watching finance currency, you know what I've been saying for weeks. I believe silver breaks 92, and when 92 breaks, 100 follows. This crash doesn't change that thesis. It strengthens it. Because what we've seen shows us that these end-of-month shakeouts are designed to reset the market, shake out weak hands, and set up the next leg higher. December did it. January did it. February is doing it right now. Silver recovers. That part I'm not worried about. What I'm watching is how fast, and if March brings the kind of demand I expect, with registered silver already at 87 million ounces and falling, the answer might be very fast. Now, I want to hear from you. What time is it right now where you're watching this? What city are you in? What country? I want to know where my finance currency family is located around the world. And drop your name in the comments. I want to see the names of my beautiful audience. Tell me. Ahmed from Pakistan watching at midnight. Sarah from Texas watching in the morning. James from London catching this on your lunch break. I want to see all of you. Drop a comment with your name, your location, and the time you're watching. Let me connect with you. Because this channel isn't just about data. It's about building a community of people who understand what's really happening in these markets. Are you buying this dip or waiting? Have you noticed the end-of-month pattern before? I want to hear your take. And share this video with anyone who holds silver and is panicking right now. Because they need to see this data before they make a decision they regret. The people who panic sold in December regretted it. The people who panic sold in January regretted it even more. Don't be the person who panic sells in February and watches silver rip back to 95 in March. The data is on your side. The pattern is on your side. The smart money positioning is on your side. You already know what happens next. Different month, same playbook, price drops, people panic, smart money loads up. Next month starts and it rips. The people who sold at the bottom kick themselves. The people who held or bought are rewarded. Which one are you going to be? If you haven't watched my last 3 videos, go watch them now. I covered the Shanghai explosion, the China versus America metals war, and the Wells Fargo delivery bombshell. Links are in the description. Together with this video, you now have the complete picture, the data, the geopolitics, the deliveries, and now the manipulation pattern. Subscribe to Finance Currency if you haven't already. Hit the notification bell so you don't miss the March update. Because when the vault numbers come out next week, I'll be covering them live. This is Finance Currency. Don't panic, stay sharp, stay stacking, and I'll see you in the next one.